Good afternoon, everyone. I'm Gillian Sadler. I'm chair of the Ulster Society, and it's my pleasure to welcome you to the latest in our series of webinars with A&L Goodbody, the Society's legal partner. This is now a long-running series of webinars, and feedback shows that our members really do appreciate them. We're really thankful to A&L for giving their time and expertise in delivering these sessions, and for anyone who wants to catch up on previous sessions. They are available on the website charteredaccountants.ie/Ulster. For today's webinar, we have four presenters from A&L with Ciaran, McAlinney, Judith Brown, who are both partners with the firm, and they are joined by two of their senior associates, Philip Hill and Rebecca O'Flaherty. The team are going to provide us with an overview of the legal issues associated with secured lending and financing, covering types of facility agreement, security types, land and assets, other types of financing, special purpose lending, topical issues including ESG, insurance requirements, ECTEA and NSIA, and some tips for approaching refinancing. So Ciaran, Judith, Philip and Rebecca, we are delighted to have you with us this afternoon. Now, as always, we are keen to encourage participation from our viewers. So please do feel free to pop your questions into the Q&A box at the bottom of your screen. The Q&A is open now, so you can go ahead and type in any questions you have for the team at any stage during the presentations. I would ask that you do keep your questions general in nature. The panel aren't able to deal with specific legal queries on a webinar, but their contact details are available should you wish to discuss something directly with them in more detail. So we have a lot to get through. We'll get started and I'll hand over to Ciaran. Thank you.
Thanks, Gillian, and hello, everybody. It's great to be here. So over the next 45 minutes or so, we wanted to speak to you on the subject of secured lending, and under that umbrella, say a little bit about different forms of loan facility documentation we would typically find in this market. So I'll cover that bit. My colleague Judith Brown is going to speak about taking security and some of the issues we would typically encounter in taking security in this market for various loan obligations. Judith's also briefly going to mention a little bit about some cross-border issues that we would encounter from time to time in taking security and also in secured lends. There are some topical issues that we've encountered over the last couple of years. We'd also like to flag, which may be of interest. So my colleague Philip Hill is going to speak about insurance requirements in secured lending transactions. And my colleague Rebecca O'Flaherty is going to say a few words about how ESG, quite a topical thing at the moment, is applied in lending transactions in Northern Ireland. And we'll conclude with some practical thoughts on approaching financings or refinancings in our market. So first of all, different types of loan facility documentation. There are probably principally two forms that we would see in our market. Bank facility letters and what's known as the LMA, or the Loan Market Association form of documentation. Turning first of all to bank facility letters, that's probably the majority of the documentation we'd expect to see, and certainly in the most common form. Typically produced in a bank standard form, and it would cover facilities such as a revolving credit facility, term loans and overdrafts. Probably worth noting in some cases that they can be expressed to be on demand, which implies they're not necessarily committed and in theory can be repayable at any time. Styles and approaches of documentation vary quite significantly between different financial institutions and banks. But as a general generic point, we probably say they're drafted in such a way so as to seek to cover banks' risks adequately. And as you can imagine, if a bank is dealing with a broad range of borrowers, they need to cover a few eventualities in their documentation. From a borrower's perspective, it's probably worth being aware of the accompanying terms and conditions. So quite often there's a booklet of terms of conditions that come along with the facility letter. And that's quite often where the more extensive terms and the restrictive covenants and so forth can be found. So always have a look out for those. What are the advantages and disadvantages of facility letters? They're generally speaking shorter and therefore slightly quicker to execute than say the LMA, which of course can have its knock-on effects in terms of costs, which tends to be a good thing, obviously. They do, in our experience, tend to be a bit less negotiated. Therefore, there's an argument they offer a little bit less flexibility. So, for example, if a particular business needs to make an acquisition or a specific distribution, or has a specific project in mind, it may need to negotiate that specifically at the time, or as more usually the case, seek consent from the bank at the point they need to execute whatever the particular arrangement is. So turning now to the LMA, or the Loan Market Association, it's a representative body that's developed out of the London syndicated loan markets over probably the last 25 years or so. And its influence is spread right across Europe and across the loan markets. The LMA have a relatively large number of what they call recommended documents, which are used by law firms and also banks. And it's important to note that the LMA, it's not a precedent as such, but they emphasize that it's a starting point for negotiation. So the anticipation is that terms will be negotiated and eventually settled. There's various forms of LMA, put a sort of short number of them on the slide there, ranging from investment grade. So, for example, highly rated, very less risky borrowers, to leveraged finance precedents, which typically would be private equity sponsor-driven financings, to real estate financing, export finance, and we've also seen other adaptations and things like project finance. One question is worth asking ourselves is, what form would we typically see applied in our local market in Northern Ireland? And in our experience, it actually tends to be a hybrid of the investment grade unsecured document and the leveraged secured document, which is slightly more extensive. And the reason for that, without going into too much detail, is that typically the majority of transactions on our market tend to be secured. I suppose another observation we would make, if you went back maybe a decade or less even, the LMA typically tended to be applied in the largest lending transactions in our market. And we're seeing that moving now, probably seeing it even applied in what we would call mid-sized transactions. But also some lenders, particularly some of the alternative lenders or private credit lenders, for example, will use it as their default documentation right from the get-go. So what are some of the advantages and disadvantages of the LMA? They're obviously larger documents, therefore they may take longer to put in place. And so there's more negotiation. There's inevitably a little bit more cost associated with the timetable to reflect negotiations, etc. They generally have more covenants to consider and to negotiate. But that said, we would increasingly be of the view that banks' terms and conditions are becoming more voluminous, or in some cases actually reflect the LMA itself. The form of document contemplates specific permissions. So some of the issues that we flagged and reflect in relation to facility letters, for example, that might need specific negotiation or consent, such as a business expansion, a business acquisition, it is assumed as a default setting will be negotiated in the LMA. So there are specific permissions such as permitted acquisitions, permitted indebtedness, permitted distributions with associated financial baskets, etc., in the documentation. And the advantage we believe of this is that once that's negotiated, then the borrower, but also to a degree the bank, have certainty over what can be done operationally and what the business can do. I suppose the last comment I would make about the LMA as well is we feel that the documentation is probably slightly better set up for specific purpose financing. So, for example, development finance, financing involving an SPV, or project finance, for example. So that was a quick canter through different forms of facility agreement. I suppose what we wanted to do now was just to give you a very general sense and a flavour of the main themes and contents of a loan agreement itself. Probably we could actually take an entire session on the contents of a loan agreement by itself, which we're of course happy to do at another stage. So this will be relatively condensed. And I just would note for the purposes of the slides that the graphics are probably setting out the typical position in an LMA form of facility agreement as opposed to a bank facility letter. So turning to the slide, on the left-hand side there's the facilities clause. That sets out the typical type of facility being made available by the bank. Could be a term loan, could be a revolver, could be a letter of credit, or indeed there could be ancillary facilities provided under the main revolving credit facility. The purpose clause, which is really what is the specific purpose of the loan being made available. A lender there will want to make sure that the purpose obviously isn't illegal, so it'll have consequences for them, but also reflects the specifics of their credit committee approval. Conditions of utilization. So this is really after satisfying all the CPs and conditions precedent to signing. What other conditions are specified before you can draw down the loan? So for example, have you delivered your compliance certificate in respect of financial covenants? Or if it's a construction loan, a development loan, have architect certificates or, for example, project manager sign-offs been obtained before the next loan can be advanced. Repayment, prepayment on the right of your screen there. Not rocket science in the sense there'll be a lot of things you typically expect to see, like is it amortizing, is it a bullet repayment profile? But I guess one thing we would draw your attention to there, when considering these type of documents, are there any mandatory prepayment events specified? So for example, if there's a windfall event in the business, say a significant disposal or an insurance event, will those funds be expected to repay the loan either entirely or in part? So worth looking out for. Interest rate provisions on the left-hand side of the slide there. Again, nothing that out of the ordinary and what you expect to see. So what's the duration of an interest period? What is the margin and so forth? Probably, worth looking out for things like, are there capitalized interest provisions if that's relevant to your particular transaction or group circumstances? And probably as another observation, it was certainly a section we spent a lot more time on around 2020, 2021, when we were migrating from LIBOR interest rate provisions to so-called SONIA risk-free rate provisions. Fees will set out just arrangement fees and commitment fees, as you'd expect. And then tax provisions, they're not really typically, in our experience, much of an issue with UK or Irish borrowers. But if you have a borrower in a different jurisdiction, it may become more involved. Worth noting that typically withholding tax risk tends to be a risk that's expected to be passed to the borrower. So then to move on to what we sort of describe as the back end of the loan agreement. And I guess worth noting in particular that this is the area where we would have most interaction with our clients, whether that's the borrower or whether that's the bank themselves. So just to walk through that briefly, on the top right there, you've got guarantees. So if there are a number of obligors, say in a group scenario, that's where they typically join as a guarantor of the main loan. This could be standalone in a bank facility letter, so there could be a separate guarantee for those purposes. The representations there, so the rep and warranty package, as lawyers like to call it, there's a degree of overlap with covenants, but the general purpose of them is to ensure disclosure, one, on signing of the loan agreement, and two, on relevant matters throughout the duration of the loan. On your right-hand side, information undertakings typically relate to financial information and when it's delivered. So, for example, annual audited accounts, quarterly management accounts, but maybe sometimes it's agreed there'll be monthly accounts delivered as well. So that will deal with those matters and the associated timing and detail around that. And as I said, that's typically an area where we'd expect a reasonable amount of interaction with the client on. Moving on then, on the left-hand side, financial covenants. Expect to see in most, certainly corporate loan agreements, could be a leverage covenant, cash flow cover, or an interest rate cover covenant included. And again, we would typically need some input from our borrower bank clients in terms of what was agreed. And in particular, as can often be the case, there are long form definitions of things like EBITDA. We clearly need some input on the appropriate approach and definition there. General undertakings as well, sort of as I point I've made earlier, this is a key part of LMA documentation, and one that you would expect to spend a reasonable amount of time negotiating and getting right. So the agreement contemplates various permissions for things like permitted acquisitions, permitted disposals, maybe permitted distributions to shareholders, financial indebtedness. Is there any third-party indebtedness outside of the this bank relationship we're negotiating, guarantees to third parties, security, and a number of other things. So a big part of negotiations will be sitting down to consider what's appropriate and to agree, what's appropriate for the borrower and that particular transaction. So that's something in particular we wanted to draw your attention to. I'd also note that in many cases, some of these permissions are dealt with by way of financial baskets. So, for example, you're given a permission to acquire companies in Europe up to a limit of 1 million without bank consent or subject to a limited degree of bank consent, just as an example. Finally, events of default. I'm sure many of you will have come across in bank facility agreements and facility letters. They're really the trigger events when things aren't going so well. Obviously, a key section as well. Typically, there'll be some negotiation about some of the events of default and where they're appropriate for a particular transaction, but also typically we'd expect to see grace periods negotiated. So a non-payment event, you may have a few days or so to make the payment before it actually triggers an event of default. So those are the main sort of aspects of a loan agreement. I'd probably, just before I hand on to my colleague Judith, briefly mention the end section of the, in particular an LMA loan agreement, but can also feature in bank facility letters. There can be an awful lot of schedules. Generally, we think a good thing because a lot of it's quite formulaic. So, for example, you'll have a form of compliance certificate to deliver to the bank, typically once a quarter, to demonstrate compliance with your financial covenant. There could be a utilization request in there that just sets out the detail around how to draw down a loan, interest periods and so forth, amounts, etc. And then finally, I just draw your attention to condition precedent, which are all the conditions to be satisfied, typically to signing a loan or at least to first drawdown of a loan. They're typically mostly legal points, so corporate approvals or maybe diligence aspects, but there are commercial aspects as well where we would need some interface with our borrower and bank clients. So are there valuations? Has there been acquisition diligence? Has there been financial due diligence? And that would typically be reflected there. So that's a very quick canter through the anatomy of a loan agreement. And I'll now hand over to Judith, who's going to speak to you for 5 or 10 minutes about security issues that we would typically encounter.
Thanks very much, Ciaran, and hello, everybody. As Ciaran says, yes, I'm going to take a little bit of time to talk about security, because security over the assets of the group of companies will, of course, be a core component for the financing in the vast majority of loans that we would see in the NI context, with the details of the security probably agreed between the company and your lender in your very initial discussions at the outset before you really get moving with the legal and various diligence processes. We know, as this cause forum will be very familiar with, the types of security that are appropriate for a deal will be dictated by a whole range of factors, chief among them the nature of the finance, the type of finance and facilities, and the type of business. So, for example, for corporate and leveraged finance, typically all assets security agreements from the relevant companies in the corporate structure up to the borrower and the holding company, and a charge on shares from the parent or top company. And then for real estate finance layered on top of that, you will typically have mortgages over the properties, probably security over the income stream, often bank accounts, security and material contracts, through then to a whole host of very bespoke security types for financing of particular types of project. Almost invariably, there will be a cross-guarantee structure from certain companies that is agreed between the group of companies and the lender. That might be all the subsidiaries, or it might be just only certain companies in the group, depending on materiality. And very often as well, there will be subordination and inter-lender documents. This is becoming more of a standard feature, and I'm not just talking about the larger financings. Subordination is very, very typical now. Two main types of subordination that I'm referring to. Firstly, third-party subordination from, for example, mezzanine lenders or junior debt providers. That is very often needed. And then almost, I would say, routine now, your connected party subordination arrangements from the stakeholders in the corporate group, whether they be shareholders, directors, intercompany loan providers, equity providers, all postponing their interest to the senior debt to varying degrees and agreeing certain permitted payment arrangements during the course of the loan. On LMA deals, following through from Ciaran's point, the security documents based on LMA starting formats also tend to have more scope for negotiation, similarly to the facility agreement itself. Scope for negotiation and tailoring to the very specifics of your individual business and your transaction. The facility agreement is the document that contains a whole host of details on your warranties, covenants relating to your asset package. So the focus for the company and the lender and the lawyers, of course, on an LMA documented transaction tends to be that the security documents are consistent with the negotiated position in the facility documents. For transactions then, where standard form security documents are used, These tend to be in a settled standard lender form with less scope for negotiation. And in that context, the security documents contain a lot of the detail on the asset obligations and do need careful review along, as Ciaran says, the lender's standard terms and conditions, so that if there are any provisions in those standard terms and conditions or security documents which don't work for the business, they can be addressed and hopefully dealt with at the outset and a solution found. So for the benefit of all the parties, and whether LMA or standard form funding, there are areas that we find it can be helpful to front end, and I will take a few minutes just to talk about some themes, practical issues really. Things to be thinking about at the start of the legals process to help assist with the smooth running of the corporate finance, because when it comes to the security documents, there are some areas that come up for discussion and may impact on your timing more so than other areas. So firstly, interlender issues. The point here is that if you have either an outgoing lender or another lender in the corporate structure who is remaining, we would prioritise at as early a stage as possible in the transaction, working out the agreement with the other lender on the loan redemption mechanics. Or if the lender is staying and the business is going to be multi-banked, as many are, agree then the separate or mutual security and ranking. Invoice financing is an area where interlender issues may crop up. Often businesses with a core relationship bank will have separate invoice financing facilities provided from someone else, but the invoice financing suite of documents will typically include a floating charge or an assignment of receivables, and so necessitating an agreement between the bank and the invoice finance provider that the bank has first priority on all assets, except of course for the debt receivables, which the invoice finance house will usually have first call on. Or other interlender scenarios in a retail sector trading business, the interlender aspect might be with a trade supplier or a wholesaler. Typically in this context, we would tend to see that the bank debt will rank first, but not always. We've seen a range of transactions where a different agreement was reached between the parties specific to the business, and this is the sort of thing that can take a bit of time to work through, and so is good to front end. The second area where in practice front-ending can be very helpful is bank accounts. And what I'm talking about there is both having the bank account set up and then arrangements for blocked and non-blocked accounts. I suppose, you know, the reason for this compliance requirements that banks have to operate to now necessitate a longer time scale between application to account opening, and we have seen quite a few transactions where the process was started quite late and then specific arrangements had to be made to deal with the bank account CPs after completion because it just couldn't get there on time for signing. Bank accounts are especially important, as many in this group today will know, in real estate and special project finance. And if needs be, after completion, you know, the documents can be amended so that whatever accounts aren't ready for completion can be dealt with afterwards, and the drawdown conditions amended. But it's just more efficient for everyone if bank account mechanics don't become a problem at a late stage, so that you don't need to go down, spend time trying to find workarounds. Then blocked bank accounts is the other point on accounts I want to touch on. This can be an important part of lenders' requirements, especially when debt service payments are funded through real estate or other project operating income. For example, you know, office buildings, shopping centres, hotels, student accommodation. There's a lot of that locally now, but where this element can take a little bit of navigation is if the details of the account blocking required by your lender bank doesn't quite fit with your account bank's policies and operational systems. And what I'm talking about here, typically your lender bank who is taking a charge over the whatever funds are in the account will require the company group to notify the account bank that only the lender and not the borrower has signing rights to withdraw or operate that particular account, say it's a deposit account or a rent receivables account. And whilst your account banks, usually will want to facilitate, these forms of notices can sometimes be problematic to the account bank from a policy or systems perspective. So the account bank may need to take the step of agreeing amended terms or additional mandate requirements with the group of companies so that it would not find itself responsible if, say, for example, funds came out of the account in contravention of the blocking protocol. The next point in terms of issues and practical considerations during this security process I want to mention is insurance. Insurance is another issue that, in our experience, it's become increasingly important to deal with insurance and think carefully through the insurance requirements at the start. The common feature, I suppose, in terms of all three of these issues, insurance, bank accounts, interlender issues, is that there's third-party involvement with the need for engagement that's outside the control of your corporate group and the lender. Phil will touch in a bit more detail on insurance requirements and trends, but really I just want to make the point that involving the broker or the insurance advisors at an early stage is helpful because insurance requirements tend to be more involved now than they were in the past, and it's good to take steps early to avoid insurance becoming, I suppose, one of the last open points left when all parties are racing to complete a complex corporate financing transaction on a target date. What we do most of the time now in practice is extract out all of the insurance obligations and covenants at the very start from the facility documents and pick them up with the company and the broker or advisors to get the ball rolling. Lastly then, on security requirements and front-ending, I just want to mention agreed security principles. Ciaran mentioned the role that LMA documents play in assisting groups of companies with flexibility for growth and permitted transactions. And in larger transactions, often your loan document will have a schedule of agreed security principles where the parties agree in advance the parameters that will decide what additional companies will become obligors in the security structure during the term of the loan and, join the guarantee at a later stage and provide security in the future. For example, if you have a subsidiary that, at some point in the term of the loan has grown, so that it comprises more than a certain threshold percentage of EBITDA, and then what that security from any additional security providers will cover, whether it be all assets or not. And helpfully agreed security principles will usually recognise that when it comes to actually putting the security in place, there may be local law divergences in other jurisdictions that haven't been envisaged and really prevent the company from providing a certain type of security rather than it being then a problem for the company that it can't provide that security. So agreed security principles can be very helpful for companies that are on an acquisition path, and especially in the context of large corporate groups or multinational groups. So I suppose segueing from that last point, the last real area I want to cover on security today is just a few common issues on cross-border financing. There are some issues that we see come up time and again on the cross-border and international transactions that we work on, and many of the cost members on the webinar today will no doubt already have encountered these on your financing deals where you have companies in other jurisdictions. Really points that it's helpful to be thinking about at an early stage. So firstly, Ireland. In Ireland, there are some nuances in companies legislation that affect security packages. And to mention just a couple of them, Section 239 of the Companies Act 2014 is the provision which restricts companies from providing loans to directors and connected parties. And in a secured lending context, it covers guarantees provided by companies for loans made to other companies. And there are exemptions for groups of companies. So the key point in terms of deciding your security package is the guarantees, cross guarantees from companies that are not in a formal group are restricted by this legislation in Ireland. And so if the company wishes to have this type of guarantee, the directors need to follow a statutory process with various directors' statutory declarations and board and shareholders' resolutions. Another point where Ireland is different now to Northern Ireland and England as well is Section 82 of the Irish Companies Act, which relates to financial assistance in a share acquisition scenario. Cause members on the webinar today of a similar generation to myself may remember the old UK financial assistance regime, which was in place before the Companies Act 2006, and the detailed auditor involved approval process that had to be gone through if a company was guaranteeing a loan or providing security where the loan was used to buy shares in the company or the company's parent. That regime was largely abolished with the 2006 Act. In Ireland, the arrangements for financial assistance for purchase of shares were amended with the 2014 Companies Act, but there's still a fairly involved process to go through in Ireland. In contrast with the UK, again, it's a statutory approval procedure. And the last point on Ireland, a very practical point just to mention very quickly, is the requirement for company seals to execute deeds. Not ideal when you've arranged your signing meeting in Belfast and you realise late at night that your seal is in Cork. Powers of attorney can be used as an alternative to seals, but the UK deed execution of a director plus a witness with no seal it's just not available in Ireland. Then, staying close to home, just to quickly touch on Scotland, there are a range of differences between security packages that tend to be available and typically taken in Scotland compared to Northern Ireland and England. And share security is an important one that I would hazard a guess you've probably seen on transactions. Because in Northern Ireland, shares can be charged in a debenture or share charge, but Scottish shares could not be charged in that same way. Instead, in Scotland, if share security was required, it meant that legal title to the shares had to transfer to the bank or the bank's nominee, and then complex enough sort of supplementary arrangements around that. But hot off the press, in a transaction we are working on at the moment with a Scottish firm, a new piece of legislation came into effect in April, the Movable Transactions Scotland Act, which greatly simplifies the creation of fixed security over a whole range of assets in Scotland, but shares is the sort of hot topic issue that the Scottish firms are all talking about at the moment. And it now means that share security can be created in Scotland without this need to have to transfer the shares to the lender or its nominee, so now closer to the Northern Ireland and English regime. Beyond then, the UK and Irish jurisdictions, and there are a number of European countries, there are notarization and apostille requirements to factor in. For example, Germany, we see these fairly regularly, and it becomes part of our role to coordinate the legal counsel in the relevant jurisdictions so that everyone is lined up on time, and that sort of timing and sequencing does require a fair degree of choreography. So the key point is planning to ensure that the lead firm is managing the law firms for you or for the lenders, whoever it may be, in all the jurisdictions. There are also some jurisdictions like the Netherlands with the concept of a security trustee, which is key to most LMA type financings, isn't recognised the same way, and so special arrangements need to be drafted in there for parallel debt provisions. Conscious of time, so the last quick point I will mention on international financing is just a quick word about the Economic Crime and Corporate Transparency Act. This features particularly in the real estate finance section. And again, I'm sure a lot of you attending the webinar today will have seen this come up on your loan transactions with your banks. Basically, overseas companies now need to disclose details of beneficial ownership in property in order to transact with property located in the UK. And you'll have seen this in your compliance documents. What we are seeing that very quickly translate into in lending documents is that lenders will require, as a CP, the overseas entity to provide details of its entity ID issued by Companies House as a condition precedent to drawdown. There's not really a way around that. And the directors will probably also be required to certify that none of the other companies in the group are subject to that legislation. So I think that was a very quick canter through some of the more common cross-border issues that we tend to see. There are lots and lots of others. Those are the common ones. And looking at the clock, I think I will hand over here to Phil, who's going to talk about insurance.
Thanks, Judith. So as Judith mentioned, insurance is a key requirement for the operation of any business or project, and something that lenders will have a focus on in finance transactions. Despite the importance of it, it's often an item which isn't given sufficient attention until close to the end of a transaction, which can lead to delays in funding. Given its importance and the involvement of third parties, it's something that should actually really be at the front and center of both a borrower's and a lender's attention. So what's the market position on undertakings and insurance obligations in both LMA and standard lender terms in Northern Ireland? So realistically, the obligations placed on a borrower will depend on the borrower's strength and the type of borrower and the type of project that's being undertaken. So for a standard Northern Ireland corporate borrower lending under bank standard terms, there will typically be a very generic clause included in the form of facility letter that requires the borrower to essentially have such insurances in place as the lender may require from time to time. Very general, very lender friendly. The LMA position is a lot more granular and a lot more nuanced, and as has already been alluded to, subject to a lot more negotiation. So large corporates with very good credit or investment grade will typically be subject to no insurance undertakings. Larger corporates in the Northern Ireland market, where there'll be security granted, will be subject to general insurance undertakings, which will require them to have insurances in place which is suitable for the type of business that they run. Where there's specific asset insurance, the LMA form may go into even more granular insurance, specifying specific assets that need to be specific assets and specific insurance that needs to be put in place. So whether that's construction risk insurance, whether it's loss of rent insurance, if it's a property specific deal, and any numerous specific insurances that might be required given the particular profile of the borrower. As Ciaran mentioned in respect of prepayments, the LMA facility also deals with prepayments in respect of insurance proceeds. So typically the facility agreement will require insurance proceeds that are recovered by the borrower to be applied in prepayment of the loans. It's quite rare that this would be a blanket requirement. Typically, there are carve-outs, so proceeds that need to be applied to meet a third-party claim, for example, public liability insurances that need to be paid out will typically be excluded from being applied in prepayment. Proceeds covering operating losses, business interruption, loss of rent are usually carved out as well. And there's also typically a carve-out for de minimis amounts. So, for example, it could be any insurance proceeds beneath £50,000 don't get applied in prepayment. One Northern Ireland specific form of insurance, I suppose, to mention is the Criminal Damage Compensation Northern Ireland Order 1977. This was introduced in response to attacks on commercial centres of towns and cities in Northern Ireland, which as a result made insurance for criminal damage and terrorist-related damage very difficult to obtain on the commercial market. This is still good law and is essentially a form of government underwritten insurance. It's less relevant now given the improved political and security situation, but it is still applicable and is still typically included in Northern Ireland facility agreements. In terms of CPs in respect of insurance, typically the lenders will require an insurance broker letter, which is a letter addressed to the lenders on which they can rely, which sets out the various forms of insurances in place and confirms that the various undertakings and lender requirements are met. In respect to the insurances themselves, the lenders will want, depending on the form of financing, the lenders will want specific interests in the insurances. So this can range from noting an interest, which essentially notes that the lender has an interest in the insurance in place, and essentially provides some comfort that the insurer won't terminate the insurance without giving the lender some notice to step in and insure the property or whatever the asset is on behalf of the borrower. A much stronger form of protection is composite insured. This is essentially a separate insurance policy in favor of the lender. The insurance isn't impacted by the behavior of the borrower. So if the borrower wasn't to pay premium for a set period of time, or if the borrower misrepresented certain information, then the insurance would still be good. This obviously has cost implications because it's essentially another insurance policy being taken out by the borrower. It's also worth noting joint insured, which is similar to composite insured, but a bit less protection, as misrepresentations, lack of premium payment, etc., can undermine the lender's interest. It's also important to note that in a composite insured situation, or even in just noting an interest, the lenders will typically want to be named as first loss payee, which, going back to the mandatory prepayment point, this essentially means that the lender will be paid the proceeds of any insurances first. There's typically a mandatory threshold put on there, a monetary threshold applied to this. So, as mentioned, similar to the mandatory prepayment, sort of de minimis amounts or amounts, being paid to third parties, etc., would be carved out. So I suppose mainly the insurance piece of a financing is largely a practical piece. And I think the points that we'd just like to emphasize for the smooth running of a transaction when it comes to insurances is just getting third parties up to speed up front. So getting the insurance broker aware of what's going on at the start of the transaction and engaging them early. Having an honest discussion between lender and borrower as to sort of cost implications, cost benefit analysis. As mentioned, composite insured will be a lot more expensive than just having an interest noted. And so a discussion on exactly what the various requirements are would be helpful. Also important to consider specific insurance requirements. So if it's a construction project, there'll need to be building all risks insurance. If it's an acquisition, there might need to be warranty indemnity insurance and any other specific project insurances. Also important just to note that it's important to know that the insurances can actually be assigned, because lenders will typically want security over the insurances. Typically insurances can be, but it's also just an exercise to ensure that. And the last most important point, I think, to an extent that comes up in transactions is, as lawyers, we can of course help on the documentation and the various undertakings and what it all means. But what we can't advise on is exactly what insurances should be in place as against this particular risk or for a particular business. That is something that insurance advisors and brokers need to advise on. So that's it from me on the insurance piece. So I'll just hand over to Rebecca now on ESG.
Thanks, Phil. So we just wanted to touch briefly just on a few issues and themes we've seen on ESG factors in finance. Obviously, it's a global agenda now, and ESG factors becoming increasingly important to investors, with nearly 80% of UK institutional investors prioritising ESG disclosures. Regulatory bodies are also introducing requirements for lenders to integrate sustainability factors in decision making. This is very common in loan markets, so we've seen especially with LMA, but we have seen it slow to come across into the local market as yet. What we have seen in the local market most commonly is margin ratchets, with the margin being adjusted according to pre-agreed rates and KPIs. Advantage for this for the lender, help to mitigate credit risk by encouraging borrowers to improve financial health, sustainability practices. And for borrowers, they also provide an incentive to improve performance and potentially lower borrowing costs. Just some practical considerations that we have seen. The margin on the loan can be reduced if the borrower meets pre-agreed ESG targets, or it can increase if they fail to meet those targets. We have seen reductions. We haven't really seen increase as so far, but just to point out that that mechanism is there. Obviously, this means there need to be specific agreement on the KPIs and how they're going to be measured and verified. This will be a crucial part of negotiation process in order to relate back to the relevant margin ratchet. Another factor we've seen is sustainability events of default. Mostly we've seen this in London, not really locally, but perhaps an illustration of things to come. As before, agreement on specific KPIs and measurement and verification is going to be a crucial part of negotiation process. Data reporting will be key in order to show that the EODs haven't been breached. And also there will be scrutiny on both sides just regarding the EODs and any associated cure periods. Also, ESG Finance Sustainability Coordinator, again, as with the events default, very common in London, international markets. In ROI, we've seen them on very big lens, but not yet in NI. They may become more common, perhaps something to come. For this is usually an individual within the banking group who undertakes an independent role to collect and verify data, and they play a key role in bridging the gap between borrowers and lenders in sustainable finance transactions. There is a fee for these services, however, which may make it not particularly viable in smaller transactions and really only in large transactions. Just to briefly touch on what the impact on businesses may be just because of these factors. So businesses will need to invest in robust data collection reporting systems just to allow them to comply with the new reporting standards just as they evolve, and also to show compliance with any EODs in the facility agreements. Obviously, this may lead to increased operational costs, but it can also offer opportunities just for innovation and competitive advantage. Obviously, ESG reporting, it still remains relatively new for many organisations, and there could be a skills gap in terms of understanding and integrating these into financial reporting processes. There's currently no universally accepted framework for ESG reporting, so it can lead to inconsistencies and difficulties just in giving disclosures and reporting data. And there will be new stricter regulations and increased scrutiny from regulators to prevent greenwashing. And regulators are empowered to impose fines for misleading green claims. So obviously this will be quite topical and will need to be really on the forefront for any issues. I'll pass you back over to Ciaran just for a roundup.
Thanks very much, Rebecca. So really, just to conclude fairly quickly, because I'm conscious of time, we thought we'd leave you with some kind of final thoughts and observations from us on, I suppose, approaching new financing transactions or refinancings if they occur, and very much from a practical perspective. So I suppose one question we would always ask, may not always be the case, particularly in smaller, more basic lends, but is there a term sheet? If there's a term sheet, it can often be a really good idea to involve your lawyers at that stage, or at least an appropriate stage of the term sheet discussions, particularly if it covers some of the legal points that we've been discussing throughout this webinar, or some of the facility agreement permissions or baskets that I had mentioned earlier, or indeed some of the cross-border issues we've discussed. Second question, is your structure clear and definitive? It's obviously best to be clear at the absolute outset as to what that looks like. And from our experience, it doesn't usually bode well if it evolves as the transaction progresses. So what sort of questions would we ask? For example, in a group financing, are we very clear on who's giving security? If it's a group scenario, what are the material companies that are providing security, and what's the extent of the security? Or are there overseas companies in the group where we might encounter some of those cross-border issues that Judith mentioned? And indeed, is it worth asking the question, you know, what are the associated costs of taking security in that jurisdiction? And indeed, is it justified purely on a cost-benefit analysis, if not for other reasons? Timetable and lead-in times, due diligence, conditions precedent. Just given the time we have left, I suspect it could roll into one section. And for us, that just generates thoughts such as, you know, has the timing on things like, for instance, property due diligence been considered? As a really basic matter in Northern Ireland, it takes at least 3 weeks to obtain the basic property searches you would need for any form of title investigation, or indeed investigation for property acquisition. Or on the company side, as Phil said, you know, will our insurers be in a prime position to satisfy the bank's requirements in terms of insurance? Will there be a broker's letter, and how long will that take to be put in place? KYC, AML onboarding, I think these days we're all pretty used to it. It's usual and mandatory perhaps, but it can take some time and it shouldn't be overlooked. In our experience, particularly where, for instance, there are overseas investors or a less than ordinary structure, it can particularly take time, so don't overlook that. Or on ESG, as Rebecca mentioned, if there happened to be a margin ratchet, for instance, in a particular lend, as someone thought about a sustainability report, which might be required to be delivered as a CP, and again, how long does that take? So I think if we were to leave you with one thought, our advice is, if in doubt, start well in advance of the timetable. Think it out in advance, and certainly don't let it run too late to your final repayment date. I think as one final thought also, is just don't forget about third parties either. They can be overlooked. So for example, is there an outgoing lender? If they're being refinanced, they may be much less to be inclined and to be in the romance phase, and therefore it might be harder to get their attention if you need releases and so forth. But also, are there other lenders, creditors in the mix? So, you know, is there, for example, equity introduced by way of debt or other forms of trade finance that either require consents or intercreditor issues that Judith had mentioned? So don't overlook that either. I think that's probably us. Just wanted to say thanks to everybody for listening, and my apologies again for the technical mishap at the start. And I think we'd be happy to open up to questions if there are any.
Thanks, Ciaran. I'm conscious of time. We do have one question. When a lender seeks a share charge to be able to take control of or sell shares in a company, especially a parent company, does this leave the borrower disadvantaged in that the lender can potentially generate significantly more value than the debt exposure?
That's a pretty good question. So they're in a large financing, they're relatively typical because it gives a lender different options. So rather than necessarily enforce debenture security potentially across a group or appoint administrators, theoretically they can dispose of it quite quickly to a third party. So we do tend to see them quite often, certainly on large financings or on special purpose financing. So say a real estate finance transaction or a project finance transaction, they would be more normal than not. Lender can only enforce the security to the extent of his debt. However, if he's done that and enforces security, there may theoretically be returns to a shareholder, but you know, that tends to be somewhat of an academic discussion. Not sure if any of my colleagues wanted to add anything there, but good question.
Yeah, I think that's a fair summary, Ciaran. And I think, you know, just to underline Ciaran's point, we would see share security as almost a standard requirement when you have a bespoke SPV structure. Maybe not so much in scenarios where you have a group of companies that, you know, where it's not an SPV structure for a specific purpose, or where it's multi-banked, but in large project finance, it's one of the standard requirements now.
Thanks, Judith. Thanks, Ciaran. Okay, look, we're slightly over time, so I'll finish up there. Ciaran, Judith, Rebecca, Philip, thank you again for your time. Thanks to those on the call. I hope you find that useful, and look forward to seeing you all again soon. Thanks.